Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we're taking a look at the dividend market and spread trading with Chuck Martin, portfolio manager at AGFIQ. Chuck discusses what has been going on in the world of dividends lately, what type of dividend-paying companies they look for, and their QuantShares ETFs as well. So if you have any questions or comments, make sure to send them in to podcast@zacks.com, and don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Chuck right after this. Okay, guys, thanks for joining me today. So we're going to be talking about some different dividend investing strategies. Now, this is something that's always a hot topic with investors, but I think you could argue dividends might have lost a little bit of their luster as of late, thanks to some of the high growth names out there that have done pretty well. So I guess I'm curious, why should investors still focus on dividends in today's market?
Thanks a lot, Eric. I think that, there's a place for dividends and certainly an income in most every investor's portfolio. A lot of people, especially as they progress in their life and in their jobs, and they start relying more and more on current income, especially as they get in the retirement years. So dividends are always going to be able to provide, some current income to those investors. What we've seen over the past 4 decades or so is a secular decline in interest rates. And we've gotten to the point, especially during the financial crisis, of where rates went virtually down to zero. And what that did is caused interest rates and bonds to get extremely low. But at the same time, what we saw is dividends in equities remain much higher. So as investors started to look for current income or current yield, dividends became more and more of an attractive way to get current income. So I still think with where Fed funds rate at a high-end target of 125 basis points, that rates remain still very low. The 10-year is well below 3%. So there's certain strategies that you can use, equity dividends, to generate current income much greater than that.
Should dividend investors be worried about, a rising rate environment?
Yeah, certainly rising rates will have an effect on dividends, but the great thing about being in an equity portfolio is dividends tend not to be fixed. So if you think about the economy, rates tend to rise when the economy is doing well, as we start to see higher GDP growth. And what that ends up doing is it's flowing down into higher profits, higher income, and eventually higher dividends. So the great thing about equity dividends compared to fixed income is that they can grow over time. So you want to make sure that you're in a strategy or in companies that are able to grow their dividends as the economy grows over time to keep up with the inflation and interest rates as they rise.
Definitely. And do you find that dividend-paying companies outperform their non-dividend-paying peers, at least, when we look at some historical measures?
Yeah, when you look at historical measures, I think dividends are a big part of the overall return over time of companies in the U.S., but really the ones that perform the best that are the ones that have either a stable stream or really growing dividends. So that's something we tend to look at, is really favoring those that tend to grow their dividends over time, because, again, those are the ones that are going to keep up with inflation and keep up with interest rates as they rise.
Now, why do you think these companies that are growing their dividends are able to outperform some of their peers? What is it about this dividend growth that seems to help their share price?
Well, first thing is it tends to be growth in the company. So you can't really grow your dividends most of the time unless you're growing the top line.
Sure.
Or growing sales. And secondly, it provides some, overall discipline to the company that, as they go through different cycles in the market, is that dividend tends to be very sticky. The last thing a company wants to do is decrease its dividend. That'll be a warning sign. So the goal is to preserve that dividend, and what that ends up doing is providing more of a steady state return, and provides almost a cushion when you have downturns in the market. So you start to see dividend-paying names tend to be a little bit more stable, especially as volatility rises, and when there's any drawdowns in the market, they certainly cushion the return versus those companies that don't have dividends and they're just purely capital gains, whether that you're looking for an appreciation in the stock price.
Yeah, and these companies that are growing their dividends, people sometimes call them dividend aristocrats. Do you think these are preferred as opposed to companies that just focus on paying out a high yield, or is it kind of a blend between the two that is probably best for people to look for?
Great question. I mean, I think it's a blend what you want to look for overall. because you certainly, while you might be a company that grows your dividend, you might have a very low yield. So, for example, you could be growing your dividend from a penny to 2 cents, which is 100% growth, but the overall yield of that company might be very low. Let's say less than 1%. So ideally, what you want to do is find those that are growing, but then at the same time do have the yields that you can get that current income from that you're relying on in your everyday life.
So let's switch gears and talk about your product, the Hedged Dividend Income Fund, ticker symbol DIVA. Now, this includes both long and short exposure to equities. What is the wisdom behind using shorting in this type of dividend-focused fund?
So over the years, we've been out, and just a brief background on us, we're very much focused on factor-based investing, and one of the things that we do is try to construct portfolios that have a bias towards a certain factor over time. In this case, we're talking about dividends as the factor. As we were out, over the past few years, going back about 5 years now, talking to investors, is most investors were asking about, do you have dividend-oriented products? Is there a way that you can create a strategy that has a very high dividend yield, but we're not taking a lot of the equity risk? Because what we've seen as investors started to flock towards dividends as interest rates are very low, we saw a lot of these dividend-based indexes increase their PE ratios from, let's say, the end of 2010 to 2017 by almost 50%. So what you saw is, as there was a crowding into this trade of dividend-oriented names, the valuations got a lot higher and portfolios got a lot riskier. So with that in mind, in using our background in building long-short strategies, we set out to try and isolate the dividend stream as much as possible. And what that entails investing in a basket of stocks that have stable or growing dividends, and then shorting out a basket within similar sectors that don't have dividends or very low or inconsistent dividends. So what we're able to do is isolate both market risk and sector risk, but again, provide investors with a income stream of about 4% annually. So what it does is it really creates a strategy that has more of a fixed income, or we'll call it a corporate bond type of risk profile, so that you're not taking a lot of the extra risk if you're moving from fixed income into an equity-based product. And that's what we're trying to provide investors with.
So correct me if I'm wrong, but it seems like it's 100% long and also 50% short. Why not go 100% long and 100% short at the same time to sort of equal things out? Or is that too market neutral for this strategy?
What we've seen is that when you look at the long securities in the portfolio, they tend to have betas that are lower, and the reason is that they're dividend-paying names. And the ones that have that were short tend to be either the non-payers or unstable companies, so their beta is a lot higher. So if you look at it on a beta-adjusted basis, it's closer to what you're talking about as far as a hedging profile. And secondly, we still didn't want to make sure that we had some type of capital appreciation built into the portfolio, so that as markets do rise over time, that we're able to actually provide some capital appreciation along with that dividend stream. So we didn't want to completely hedge out that beta that you get in the marketplace.
So are there any other characteristics that are considered besides the dividend profile that you want to discuss?
Well, certainly the sector exposures is really key to make sure that when we're providing a hedging capability is that we do have at least a 50% hedge in each sector. That's very important to us. And secondly, when you look at the overall portfolio, it tends to be a little bit cheaper on the long side than the short side because we're focusing on the higher yielding stocks that are in the marketplace.
But that's just sort of a function of the types of stocks that are included, not so much you're specifically looking for that, correct?
Right. Valuation is not a function of it, but when you look at valuation and yields, they tend to be somewhat correlated.
Gotcha. So how do you view this fitting into the average investor's portfolios? I know you mentioned the corporate bond risk profile. Do you view it as sort of a substitute for this type of exposure?
What we've done is we've looked at over time, the strategy tends to have a beta of about 0.17 to corporate bonds and about 0.40, let's say, to a dividend long-only index. We like to think of it as a complement to really a corporate bond side of the asset allocation, in that it has very low correlation to it, but it has a risk and a yield profile very similar to what you get out of a corporate bond fund without as much interest rate risk that's in a corporate bond fund, and you still have the potential for the growing dividends that you get in a dividend type of long-only equity index.
And maybe you could touch upon the expenses. I know a lot of times when funds use short exposure, it can kind of confuse some investors out there when it comes to the net expense ratio. So perhaps you could touch upon that for a bit.
Yeah, and one of the unique things that the SEC has put in is that when you do short a stock, you have to include the negative dividend that you get in the portfolio from shorting a stock in the expense ratio. So what we've seen is right now, when you look at the 30-day SEC yield, and that is as of 6/30 of this year, is the SEC yield of this portfolio is about 4.07%. And that includes all expenses. That includes both long dividend, short dividends, and all expenses that are including the short dividend expense that's in the strategy. What we end up charging when you look at our management fee and all the service provider fees is 75 basis points. So anything that we have control of beyond the dividend expense of shorting is about 75 basis points. So for a long short type of product, this tends to be at the lower end of the spectrum when you look at other strategies that are out in the marketplace, such as let's just say a pure short S&P 500 type of strategy.
Sure. And, I also want to discuss some of the other things that QuantShares is working on these days. It seems like you have a lineup of market neutral funds. What can you tell us about this suite of products?
Sure. We were really focused on factor-based investing when myself and my partner, Bill DeRoche, originally started QuantShares. We had come from the institutional side. We worked at State Street Global Advisors, where we built factor-based strategies, both long and short. And what we want to do is isolate factors as much as possible. So right now we have 3 strategies that focus on what we'll call the FOM and FENG factors. Those would be a value factor, a momentum factor, and a size factor. And all those strategies are sector neutral and market neutral. And again, trying to really focus on providing pure exposures. And what we've seen is investors tend to couple those with some of the long-only factor-tilted portfolios to create more of long-short strategies. We also have a 4th product that we use that really looks at volatility, and it's called we call it anti-beta. And this really it's really a hedging strategy that focuses on buying a portfolio of low beta stocks and shorting a portfolio of high beta stocks in a sector neutral type of framework also. And what that does is it really hedges well when the market goes down. So as volatility rises, high beta stocks tend to really underperform. So as the market goes down, what we've seen is this tends to have a down capture of negative 100%. So if you think if the market's down 10%, this goes up about 10%. Now, on the contrary, on the other side, when the market rises, that spread between low and high beta tends to dissipate, and this strategy tends to only have an up capture ratio of about negative 50%. So as the market rises 10%, this is down 5%. So this is really a great strategy that helps to reduce the volatility in your portfolio and allows for upside capture returns where it hedges out a significant amount of the downside, just depending on how much you own of it, for any type of long-only equity portfolio. And that's where we've seen a lot of interest lately, especially where we've seen markets have gone over the past 5 or 6 years after the financial crisis.
And is there anything else you want to mention about, say, the momentum or some of the market neutral value or size funds?
Yeah, sure. So value and momentum tend to be great pairs together. They tend to be negatively correlated. So a value strategy in any given year, might have very positive returns as cheap stocks outperform expensive ones. Vice versa, you'll see momentum tends to struggle that year because the high momentum names tend to have a little bit higher valuation, and the low momentum names that have a little lower valuation. What we've seen over time is both factors tend to add value. So when you use them together, they tend to provide a very good diversification, and you can get as a pair returns of anywhere from 3 to 5% above cash in a pure market neutral type of strategy. So those two tend to work very well together. And over time, as far as capitalization goes, or what we call size, that tends to focus on smaller cap names versus larger caps. Over the real long run, small caps tend to outperform because they tend to be higher growth type of stocks, and larger caps tend to be lower growth. But over the past 5 years, you've really not seen that really play out, as some of the like FANG type of names have really outperformed, and the larger caps have done very well, while small caps have somewhat trailed in the market.
Yeah, definitely. It's certainly been a tough time for those small caps out there. But, we'll have to have you on again to discuss those in greater depth. But thanks for coming on and talking about the world of dividends and QuantShares today.
Great. Thank you very much.
All right, everyone. That was Chuck Martin, the portfolio manager at AGFIQ. You can learn more about their market-neutral funds and their spread funds at agfiq.com. Well, hope you enjoyed this edition of the Duchamp Report. And make sure to tune in for more interviews and discussions in the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Duchamp Report on iTunes. And if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page at Eric Duchamp, or leave us a comment on Facebook too. But be on the lookout for a new edition of the Duchamp Report each and every Thursday. But until then, for Zacks.com, I'm Eric Duchamp.